In the iconic board game Monopoly, there's a little thrill every time you round the corner and pass go to collect that sweet $200. It's a simple joy, a reward. The real world has its own version of this easy money. That's right, we're not playing games today. Well, not literally anyway. We're talking about the real-life equivalent of passing go and collecting money. But this isn't just play money. It's cold, hard cash. And the best part? You don't need to roll any dice, buy any properties, or even take a stroll around a game board. This money comes to you while you're living your life, working, playing, sleeping, or even while you're watching this video. So how do you unlock this financial cheat code? Welcome to Fun Financial Insights, the channel where we make finance entertaining. Today, let's talk about the answer to my question, index funds. How can you have a passive income of $100 daily via index fund investments? Let's kick things off with a quick crash course on index funds. Imagine you're at a buffet and instead of choosing just one dish, you get a little bit of everything. That's what an index fund does with stocks. Stocks like pieces of a company pie. When you buy a stock, you're buying a slice of ownership in a company. And just like pie, the bigger your slice, the more of the company you own. And when the company profits, so do you, through dividends or by selling your shares at a higher price. They say you can't eat your cake and have it, but this is something close. It's like having your pie and eating it too. The way stocks are generally identified with tickers, index funds have a ticker too. Stock tickers are those snappy abbreviations you see scrolling across financial news channels. They're like the nicknames of companies on the stock market. For example, AAPL for Apple, TSLA for Tesla, and who could forget BRK.A for Warren Buffett's Berkshire Hathaway. Now, how do you know when stocks are doing well? What is the market saying? This is why we have indexes. Market indexes give highlight reels of the stock market. They track the performance of a group of stocks, giving you the gist of how the market's doing. Think of them as stock market's report card. Some of the big names you might know are the S&P 500, tracking the 500 largest U.S. companies, the Dow Jones Industrial Average, aka the Dow, which follows 30 major U.S. companies, and the tech-savvy NASDAQ composite, home to many tech giants. Indexes are the benchmark for measuring investment performances. Want to know how well your stock is doing? Compare them to an index. For those who prefer the easy route, investing in index funds lets you ride the market wave without picking individual stocks. It's like betting on the entire sports team instead of just one player. An index fund can be either a mutual fund or an exchange-traded fund, ETF. Investors buy shares of mutual funds, think of them as an actual index funds, directly from the asset management companies. Shares and ETFs are purchased and sold through stock exchanges. ETFs are investment vehicles similar to index funds, but with a twist. They trade on the stock exchange just like individual stocks. This means you can buy and sell ETFs throughout the trading day at fluctuating prices. They're the hares of the investment race, offering flexibility and variety. Index funds hold baskets of investments that track a market index, such as the S&P 500. They are passively managed, meaning the fund's holdings are entirely determined by the index it tracks. You see, the goal of an index fund is to match the performance of the underlying index. So it is always a good choice for long-term investments because you can lock in the returns of the overall stock market or a specific segment of it. The returns generated by an index fund generally never exceed the performance of the index itself, if only because of the index fund expense ratios, which are the annual management fees collected by index fund managers. Since index funds are passively managed, they're actually more likely to outperform funds with active managers over the long term. So what are the factors to consider when you choose them? Target market segment. Imagine once again you're back at that buffet. Index funds cover different selections of the market, like the salad bar, the pizza station, and the dessert table. You can choose funds that focus on tech, healthcare, or even sustainable energy. Pick your flavor. Investment goal matter. Next, let's talk about investment goals. Are you saving for retirement, a dream vacation, or that fancy coffee machine? Your goals shape your investment strategy. If you're in it for the long haul, maybe go for a broad market index fund. If you want quick gains, consider a sector-specific fund. Expense ratio. This is like the fee you pay for the gym membership. The lower, the better. Look for index funds with low expense ratios. You don't want your hard-earned money doing ninja flips into someone else's pocket. And guess what? There are index funds with no fees. Don't worry. We will look at them a little later in the video. Minimum requirement investment. Some mutual funds require a minimum investment of $1,000 or sometimes more. It is important to choose one that fits your budget so that you can put your money to work right away. Remember, even small contributions add up over time. Benchmark trading performance. Last but not least, check on the benchmark trading performance. Think of it as the index fund's report card. Compare how it performs against its benchmark, usually a stock market index like the S&P 500. If it's acing the test, you're in good hands. Next, we're going to look at the numbers. I will also share with you some index funds that you can invest in and brokers you can choose. But before we go on, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. And if you enjoyed this episode, please give us a thumbs up. To pocket $100 daily, we need to annualize it. So $100 in percent. To find out how much we need to invest, we divide our annual goal by the return rate. To keep the math simple, we'll use the formula for annual returns. Annual passive income divided by return rate. And the grand total is a whopping $527,428.57. That's the pot of gold we need to invest to earn $100 a day. Okay, I know what you're thinking. That's a lot of dough, but don't worry. You don't have to start with the whole amount. You can build up to it over time with regular contributions and the power of compounding interest. As I said earlier, investing in index funds is a long-term game. So here are 4 things you can do as you visualize attaining your goal. Number 1, start saving. Every dollar counts. Number 2, invest regularly. Set up automatic contributions. Number 3, reinvest dividends. Let compounding do its thing. And number 4, stay consistent. Rome wasn't built in a day, and neither is your investment empire. Now, what are the best funds to invest in 2024? We will look at some of them now. And many of the funds that I'm about to share with you have gone up significantly in 2023 and are off to a strong start in 2024. But remember, index investing is about building wealth for the long haul. So try not to focus on short-term ups and downs. The Fidelity Zero Large Gap Index Fund tracks an index of more than 500 U.S. large cap stocks and performs very similarly to the S&P 500 index fund. But because this fund is not an official S&P 500 index fund, it avoids paying expensive licensing fees to S&P Global, the index parent company. The fund tracks the Fidelity U.S. Large Cap Index as its benchmark. The zero in the fund's name denotes that the expense ratio for this fund is 0%. There's also no minimum investment, so it is a good choice for you if you are a new investor. The fund's performance closely mirrors that of the S&P 500. The fund finished 2023 with total returns of more than 27% for the year, slightly more than the S&P 500's total return of 26.29%. Next, the Schwab S&P 500 Index Fund is about the cheapest official S&P 500 index fund you'll find. Its expense ratio is 0.02%, meaning you'd annually pay about 20 cents for every $1,000 you invest. Further, because the investment fee is so low, your returns are virtually identical to the performance of the S&P 500. There's no minimum investment amount, so you can start investing with as little as $1. In 2022, the fund fell by more than 18%, almost identical to the S&P 500's losses for the year. The fund's total return for 2023, 5%, almost exactly matching the S&P 500's 26.29% total return for the year. Sometimes the best treasures are hidden. The Fidelity U.S. Sustainability Index Fund is a green gem, blending environmental consciousness with financial growth. Some of the top 10 stocks in the index fund by total net are listed on your screen now. It also has an annual income dividend yield of 1.02%, which can add up through compound interest in the long term, especially if reinvested. And let's not forget the T. Rowe Price Equity Index 500 Fund, a seasoned explorer with a keen eye for value. Pre-X has a 5-year return of 13.97% and a price of $133.17. So here's to planting seeds for our future wealth. May your investments flourish and your passive income flow like a never-ending river. Until next time, keep investing, learning, and enjoying those pina coladas. Thank you for watching, and don't forget to hit that like button, subscribe, and ring the bell for more financial fun.